I want to start with a change in tone that we have heard from you over the past couple of weeks. It seemed like 3 months ago you were not that urgently feeling like we needed to see lower rates. You've kind of changed recently and really seen the need for it. What's caused that change?
Well, I think two things have really happened to lead for that change. First of all, good morning. It's good to see you all.
It's good to see you.
It's really good to be here. The one change is that inflation has moved a lot faster than I had anticipated. Look, we've, for the last 2 years, have really been in a mission of getting inflation back to our 2% goal. We had seen a lot of progress. Early this year, it seemed like it may have been stalling out. I'm really gratified to see that it's continuing back on that pace, and that's a very good thing. And then the second part is the employment side. So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak, but it really starts to tell me that things are much more imbalanced than they have been for quite some time, and that's really a sign that our policy has done its job, and now we need to start the path back to our more neutral stance.
More than anyone at the Fed, you've had a more holistic view with John Chauvin at Stanford, with all the academics you've done at Southern California about racism, about society and all. We're in the maelstrom of a political election. Greg Ip, writing in the Wall Street Journal in the last 24 hours, says the politicians are not practicing economics. How does the Fed get to the September meeting, get to the November meeting, and avoid the first Tuesday of November? How do you maintain Fed independence with this crazy economic dialogue we're hearing?
So I actually don't think it's that hard to remain independent. I think for us, the job is to keep our heads down, do our work, read the data, study it, get input from businesses and people all over this country to get a good handle about where the economy is, how it's moving, and how people feel it's going to move forward, and then use that information to figure out what the most appropriate policy is. The worst thing that we can do is not do the right thing for reasons other than this not being the right thing. Right? And to me, I think we must at all times be true to our job is to set up a long-run environment for this economy so that it's got a firm foundation. And that means we can't be focused and pulled into the shorter-run issues. So I'm just going to keep my head down. The Fed has a long history of doing whatever it takes, whenever it takes, and that's what I expect we'll do too.
You've been criticized, the Fed's been criticized by a lot of people on Wall Street who say you're too data dependent, you're looking backwards too much. I don't think they realize that you're constantly talking to people in your district to get the current lay of the land. So what is that lay of the land? What are CEOs telling you about their plans and their view of demand and business going forward?
Well, Mike, you should tell people more often. We spend a lot of time looking forward. That's actually a really important thing. We do surveys. Our bank has a lot of surveys that we do asking, what's your outlook for the next 6 months, for the next 12 months, and the like. We hear a couple things. So one, we hear that the demand for product is weakening, but it's still quite solid. We hear that businesses are not expecting to expand their workforces in a very significant way, but they're also not expecting to lay people off. That is not the mode. That they're really in a steady state where they can handle where things are, and their outlook for the next 6 to 12 months is by and large positive. Maybe a little lower in terms of revenues and profits from where we've been the last 2 or 3 years, but the last 2 or 3 years have been record-breaking pretty much in every sector, every industry. So it's a solid picture, and it's one of the reasons why I do think that we've had some space to be patient with our policy moves, and we'll just have to see whether their outlook plays out. I'm hopeful that it does.
Given the problems Lisa talked about earlier with the data and coming out of the pandemic and everything, how certain are you that your data is correct enough that you're not behind the curve?
Well, I mean, we try really hard to get our view based on the pulse that business leaders are showing at every moment. We talk to folks day to day, week to week, and we ask two questions all the time. One, what's your outlook for the next 6 months? And how has that changed relative to where you were 2 weeks ago or 3 weeks ago? We are trying really hard to notice those inflection points so that we can speak to that, we can bring that to our policy table and make sure that we're not behind the curve. But these are turbulent times. As you know, I mean, you all cover the economy. things are happening in unexpected ways in many different venues and many different parts of the economy. And so there is a natural trend. There's always some uncertainty. And we've just got to sort of navigate our way through and do the best that we can to get as much information so we can make good policy.
What does gradual mean?
Oh, so that's a very good question. So to me, I think it is taking one step at a time, and after each step, looking around to see how the economy is evolving.
Okay, what everyone's asking is really, is that step 25 basis points? Is it 50 basis points? Does one mean gradual and one not?
So I would say this. The first step, it will depend on what the next couple data points come in. The next couple data points come in, and inflation is moving and unemployment is staying pretty stable, I think a move would be on the lower side. But there's a narrative that says inflation comes in super hot, and maybe we don't move at all, or that unemployment spikes in an unexpected way, and we have to move bigger. I don't want to really be sitting on any one action as my modal expectation today. I'm really going to let things play out. And, one of the things I've learned very much in the last 4 years is that getting too far out ahead of what actually happens just causes me to spend a lot of extra energy that I wind up having to sort of undo and then get to where the reality is. So I really am trying as much as possible to be in the moment and of the moment.
Well, markets are forward-looking. They're not in the moment. So everybody wants to know, where do you end up? Where do you think neutral is going to end up when you finish your cutting cycle?
So I'll say two things on this. One, in the SCPs and the dot plots, we have to put a long-run number. For me right now, that long-run number is 3%. I think it's a little higher than where it was at the depths of the pandemic. But where that is precisely is unclear. The second thing I would say, though, is I've really been focused much more on making sure that inflation gets to 2% than what a long-run number is. And now that we're close to moving on that way, that's a question that I will spend a lot more time with my team trying to figure out. In my building, we've started to have discussions / arguments about this, and in my building, I get views ranging from 2.5 to 4.25. Right, that's a large range, and we're going to have to narrow that down. And so I'm really looking forward to a robust discussion that will help me get a sense of where I think it is.
2 years ago, Jay Powell's speech was 8 minutes long. How long do you think this speech is going to be?
So, I don't get any insights on that. 8 is historically a record-breaking short. I'm not expecting we'll break records today, but we'll have to see what happens.